Stocks and bonds are the most common types of investments. Stocks offer a higher potential for capital appreciation, but come with greater risks. On the other hand, bonds are generally safer than stocks, but provide lower returns. The key to successful investing lies in finding the right balance between these two asset classes. Choosing the right mix of investments is essential for managing your assets effectively and ensuring they continue to grow over time, even during challenging market conditions. In this video, we'll explore 10 high-growth assets that could help you build long-term wealth. Welcome to Moving Up Wealthy, your partner in the journey towards wealth and success. Stocks and bonds. Stocks and bonds both play essential roles in a well-balanced investment portfolio. However, it's important to recognize that they come with distinct characteristics and potential returns. Stocks offer investors the opportunity for significant capital appreciation through price increases and potential dividend payments. Bonds, on the other hand, provide more stability and are generally considered safer investments. They offer regular interest payments and return the principal amount upon maturity. Balancing the risks and rewards of stocks and bonds is essential for a successful investment strategy. By diversifying your portfolio with a mix of both types of assets, you can potentially take advantage of the growth potential of stocks while mitigating risks with the stability of bonds. Real estate. Real estate can indeed be an excellent investment vehicle for many reasons. As mentioned earlier, Warren Buffett has expressed his confidence in real estate as a long-term investment, emphasizing its potential for increasing value over time. Purchasing a home can be a sound investment, especially if you plan to live there for an extended period and then sell it later or rent it out. Additionally, real estate properties can generate passive income through rental payments, offering an alternative income source for investors who do not reside in the property. Diversification is a crucial aspect of a successful investment strategy, and adding real estate to your portfolio can help reduce risks associated with stocks and bonds while still providing growth opportunities. Lastly, it's important to note the tax benefits associated with real estate investments. Real estate taxes are deductible against your federal taxes, and in some cases, state taxes as well. Cryptocurrency. As an investment vehicle, cryptocurrencies have garnered significant attention and interest over the past few years. The most well-known cryptocurrency, Bitcoin, has experienced substantial price fluctuations, with some investors reaping substantial returns on their investments. However, investing in cryptocurrencies also comes with inherent risks and challenges. Some cryptocurrencies have shown impressive growth rates, offering investors the possibility of significant returns. Adding cryptocurrencies to your investment portfolio can provide another layer of diversification, as they may not be correlated with traditional asset classes like stocks and bonds. Cryptocurrencies can be traded 24/7 from anywhere in the world, making them accessible to a wide range of investors. Cryptocurrencies are known for their extreme price volatility, which can lead to substantial losses as well as gain. While blockchain technology is inherently secure, there have been instances of hacks and thefts from cryptocurrency exchanges and wallets, leading to significant losses for some investors. Mutual funds. As mentioned, mutual funds invest in a wide range of stocks and bonds, ensuring that investors' money is spread across multiple assets. This diversification helps mitigate the risk of significant losses due to the poor performance of a single company or market sector. Mutual funds are managed by professional fund managers who have the expertise and resources to analyze markets, select appropriate investments, and monitor their performance. Mutual funds can be easily bought and sold on any business day, providing investors with liquidity and flexibility in managing their investments. Mutual funds often offer the option of reinvesting dividends and capital gains automatically, allowing investors to benefit from the power of compounding and grow their investments over time. There are numerous types of mutual funds available, catering to different investment objectives, risk tolerance levels, and time horizons. This variety allows investors to choose the funds that best align with their specific needs and goals. Exchange traded funds. Exchange traded funds tend to have lower expense ratios compared to traditional mutual funds, primarily due to the absence of active management. This can result in significant cost savings for investors over time. As mentioned, exchange traded funds are generally more tax efficient than mutual funds, as they do not have capital gains distributions. Investors are taxed on dividend payments received from their holdings, which usually occurs once a year. Exchange traded funds can be traded like stocks throughout the trading day, allowing investors to buy or sell their shares at any time the market is open. This provides more flexibility compared to mutual funds, which are typically priced and traded only once a day. Exchange traded funds are available to a broad range of investors, including individual investors, institutional investors, and even those with limited funds, as they often have no minimum investment requirements. Bonds. Bonds provide a fixed stream of income in the form of periodic interest payments, which can be particularly attractive to investors looking for a steady source of income. Bonds can provide diversification benefits to investors, as they tend to have lower volatility compared to stocks. This can help to reduce the overall risk of an investment portfolio. Bonds can be an effective tool for capital preservation, as they tend to be less volatile than stocks and may be less sensitive to changes in market conditions. Bonds can offer higher yields than savings accounts or other low-risk investments, making them an attractive option for investors seeking higher returns. Certain types of bonds, such as municipal bonds, offer tax advantages to investors, as the interest income may be exempt from federal and or state taxes. Alternative investments. Alternative investments, less liquid than stocks or bonds, offer long-term investment opportunities with potentially higher returns, but also higher risks. These assets include real estate, private equity funds, hedge funds, commodities, and limited partnerships in non-tradable securities. For investors willing to face the downsides, alternative investments can offer significant potential for portfolio growth. Retirement planning. Retirement planning is an important aspect of personal finance. To save for retirement, investors can choose from different types of investment vehicles. Mutual funds are collections of individual stocks and bonds, which provide diversification across many companies or industry sectors. Index funds, on the other hand, track an index like the SCUP 500, hence they perform similarly over time, but with less risk as they don't employ fancy trading strategies or rely on expert stock pickers' opinions about which companies will outperform others in coming years. In addition to mutual funds and index funds, exchange-traded notes also provide investors exposure to commodities such as gold or oil without having to buy physical barrels themselves. It's important to note that different investment vehicles come with varying levels of risk, return, and investment time horizon. Investors should carefully consider their risk tolerance and investment goals before choosing an investment vehicle. Financial independence. Financial independence is a key goal for many investors. It means having enough money to live on for the rest of your life without relying on work income. Investors seeking long-term wealth and financial security often choose high-growth assets, such as stocks or real estate, over safer investments like bonds or cash equivalents. This can help balance risk and reward and ensure that their portfolio can withstand market fluctuations and changes over time. With careful planning and a long-term approach, financial independence is achievable for many investors. Investing properly can help you build long-term wealth, but it requires financial planning and risk management skills to do so successfully. To build long-term wealth through investing, it is important to have a solid financial plan and the ability to manage risk effectively. Investing is not a get-rich-quick scheme, but rather a long-term strategy that requires patience and discipline. Effective risk management is also critical to successful investing. This involves diversifying investments across different asset classes, industries, and geographic regions to reduce the impact of any one investment on the overall portfolio. The bottom line: investing can help build long-term wealth and achieve financial independence. However, it requires careful financial planning and risk management to do so successfully. Investors should have a clear understanding of their financial goals and risk tolerance and create a diversified investment portfolio that balances risk and reward. With patience, discipline, and a long-term approach, investors can build wealth and achieve financial freedom over time and enjoy a brighter financial future. Thanks for watching. If you enjoyed this video, please hit the subscribe button to join our amazing community and click the bell icon to receive notifications whenever we post new content. Don't forget to like, comment, and share for more great content. Visit our website at movingupwealthy.com and check out our suggested videos. We'll see you in the next video.